It is April 27th, 2026. While retail narratives focus on daily sentiment swings, smart money is quietly executing a massive institutional repositioning. Tracing this footprint through the OmniSense AI Top 20 Institutional Watchlist reveals a glaring anomaly. A dense cluster of Ethereum puts expiring on April 28th command top actionable AI scores, reaching 67.9 for the $2,460 strike. This chart displays the contradiction. Spot Ethereum is sitting at roughly $2,298, yet institutions are acquiring heavy volume in the $2,420 to $2,480 put range. Institutions are paying massive in-the-money premiums for protection on an asset trading below the strike price. This aggressive positioning suggests that internal risk models are pricing in a rapid, near-term repricing. You might assume large funds have simply lost faith in Ethereum's technology or adoption curve, but that ignores how institutional quant desks actually operate. When funds need protection against a systemic economic shock, they utilize high beta hedging. They use the market's most volatile assets as a proxy to short the broader macroeconomic environment. To prove this specific flow is a macro hedge, we will reverse engineer it. We work backward through digital assets, through global equity and bond positioning, and ultimately into physical supply chains. Decoding this single options cluster will reveal the exact architecture of an impending global risk-off regime. We start by moving from the derivatives market to the broader digital asset spot environment to look for corroborating weakness. U.S. spot Bitcoin ETFs are hemorrhaging capital, with $185 million in net outflows. BlackRock's IBET leads the exit with $137.9 million, followed by Fidelity. Moving down the risk curve, we check the Layer 1 and DeFi sector heat maps. Major Layer 1 networks like Solana and Avalanche are dropping over 3%, while the speculative AI token sector is facing absolute capitulation, with assets like SingularityNet down 76%. The ETF bleeding and severe altcoin capitulation confirm the Ethereum put flow is part of a systemic institutional rotation completely out of digital assets. Now we pivot our investigation away from digital assets and directly into traditional U.S. equities and key volatility metrics. This chart tracks the VIX. We can see it pushing to 18.71, driven upward by stress around tech earnings and capital expenditure risk. To see how smart money responds, we examine the Commitments of Traders report. Leveraged funds are aggressively shorting. S&P 500 futures net short positioning sits at negative 62.4%. This pressure extends into tech, with the Nasdaq 100 facing a negative 27.7% short position. We cross-reference this equity stress with the bond market to check for corroborating yield curve data. The 10-year Treasury yield is holding at an elevated 4.31%. More importantly, the 10-year to 2-year yield spread remains inverted at positive 57 basis points, a classic warning signal. Leveraged funds shorting indices, high bond yields, and an inverted yield curve confirm a classic multi-asset risk-off regime where traditional safety valves are failing. Financial dashboards alone do not explain the cause. We must step away from the terminal and pull up the physical supply chain and geopolitical map. We focus the investigation on the Middle East, specifically the Strait of Hormuz choke point. World Monitor flags this terminal with a severe 70 out of 100 red risk. Driven by blockade risks, physical transit through this bottleneck has dropped 12% from baseline. Just to the southwest, the secondary choke point at Bab el-Mandeb is flashing a critical risk level. Persistent Houthi attacks have pushed that corridor to an 80% disruption rate. These dual maritime chokeholds connect directly to the global energy complex. This chart demonstrates the immediate consequence on the live tape. As transit volumes drop, Brent crude has broken the psychological $100 barrier, surging to 101.91. The entire architecture of financial market stress, from the VIX to the S&P shorts, is mathematically rooted in this physical blockade, which is revising global energy supply projections for the remainder of the quarter. When crude oil sustains levels above $100 a barrel, that cost immediately filters into domestic economies. The energy spike stalls disinflationary trends. The latest data shows the consumer price index reversing course and rising. This forces a reaction from the Federal Reserve. The Fed is trapped. They cannot cut the 3.64% rate while war-driven inflation is resurging. Prediction market data confirms the market is rapidly pricing out any rate cuts for 2026. This forced higher-for-longer rate environment tightens the pressure on global liquidity, the exact scenario institutional traders dread most. The sequence is clear. Geopolitics throttles Hormuz, which spikes oil, triggering sticky inflation and rate paralysis, leading to a broader liquidity contraction. When an unexpected liquidity contraction hits, high beta assets are the most acutely vulnerable. In the modern institutional portfolio, Ethereum is the ultimate high beta risk-on asset. Re-examining the Omniscience AI options flow, massive premiums for April 2026 Ethereum puts at $2,460 act as highly leveraged insurance against a global liquidity shock. Institutional desks are utilizing crypto derivatives as a weaponized hedge against a geopolitical war happening 7,000 miles away.